Welcome to this video on the importance of financial statement in strategic decision making. Financial statements are fundamental tools that help organizations to understand their financial performance and position. They provide valuable information that support effective business decision and long-term success. In this video, we will discuss the purpose of financial statements and their key components, how they are interconnected, and their roles in strategic decision making. Financial statements are essential for every organization because they provide reliable information about its financial health and overall performance. They help managers, investors, creditors, and other stakeholders to evaluate the organization's financial position, monitor business performance, and make informed strategic decisions. By supporting planning and efficient resource allocation, financial statements contribute to long-term sustainability and business growth. This slide highlights the purpose and components of financial statements. The purpose of financial statement is to evaluate financial performance, assess the financial position of an organization, support planning and decision making, and provide transparency to stakeholders. Financial statements consist of four main components. Income statement, which report revenues, expenses, and profit or loss. The balance sheet, which presents assets, liabilities, and equity. The cash flow statement, which shows cash inflows and outflows. And a statement of changes in equity, which explains the changes in owner's equity during the reporting period. Together, these statements provide a comprehensive view of an organizational financial health. The income statement is one of the primary financial statements used to assess an organization's financial performance over a specific accounting period. It presents three key components: revenue, which represent the income earned from providing services; expenses, which include all costs incurred in generating that revenue; and the resulting profit or loss, which indicates whether the organization has earned a surplus or incurred a deficit during the period. The income statement is important because it measures the organization's profitability, allowing management to determine whether the operations are generating sufficient returns. It also evaluates the operational performance by highlighting how effectively revenues are managed against expenses. Furthermore, the information provided by the income statement supports budgeting and strategic planning, enabling managers to make informed decisions regarding cost control, resource allocation, and future growth. The balance sheet provides a snapshot of an organization's financial position at a specific point in time. It consists of three main components: assets, which are the resources owned by the organization; liabilities, which represent the financial obligations owed to creditors; and shareholders' equity, which reflects the owner's residual interest after liabilities have been deducted from assets. The balance sheet is important because it provides a clear picture of the organization's overall financial position, enabling stakeholders to understand its financial health. It also assesses liquidity and solvency by indicating the organization's ability to meet its short-term obligations and sustain long-term financial commitments. Furthermore, it supports investment and financing decisions by providing reliable financial information that help managers, investors, and lenders make informed decisions. The cash flow statement shows how cash moves into and out of an organization during a specific accounting period. It is divided into three sections: operating activities, which include cash generated from day to day business operations; investing activities, which involve the purchase or sale of long term asset and investment; financing activities, which include cash flows related to borrowing, repaying debit, or issuing shares. This statement is important because it tracks cash inflows and outflows, help maintain business liquidity to meet financial obligations, and support effective cash management decisions for the organization's financial stability and growth. This slide illustrates the flow of information between the financial statements. The process begins with the income statement, which calculates the organization's net income or net loss. This net income is then transferred to the balance sheet as part of returned earnings, affecting shareholders' equity. The cash flow statement explains how cash has moved during the period through operating, investing, and financing activities. These statements are interconnected, with information from one statement influencing the others. Together, they provide a complete picture of an organization's financial performance, financial position, and cash flow, enabling informed decision making by management and stakeholders. Financial statements play a vital role in supporting organizational decision making and long term success. They provide reliable financial information that help management develop effective strategic plan aligned with organizational goals. Financial statement also assist in resource allocation by ensuring that financial, human, and operational resources are distributed efficiently. Thus serves as a foundation for budget preparation by providing historical financial data and supporting future financial planning. In addition, they help organizations manage cash flow effectively by monitoring cash inflows and outflows to maintain liquidity. Financial statements also support investment decisions by enabling managers and investors to evaluate financial performance and growth potential. Furthermore, they facilitate risk assessment by identifying potential financial challenges and areas requiring corrective action. Finally, financial statements are essential for performance evaluation as they allow organizations to measure financial results, monitor progress towards objectives, and improve overall operational efficiency. Financial statement analysis is an important process that helps organizations evaluate their financial performance and make informed business decisions. It enables management to identify financial strengths and weaknesses, allowing them to capitalize on opportunities and address areas requiring improvement. By comparing financial performance over time, organizations can monitor trends, measure progress, and assess whether strategic objectives are being achieved. Financial statement analysis also facilitates benchmarking against competitors, helping business understand their market positions and identify best practices. Furthermore, it supports improved operational efficiency by highlighting areas where costs can be controlled and resources can be utilized more effectively. Ultimately, financial statements analysis provides valuable insights that support sustainable business growth by promoting sound financial planning, informed decision making, and long term organizational success. Financial statements provide reliable and structured financial information that reflects an organization's financial performance and position. They play a vital role in supporting strategic planning by enabling managers to make informed decisions based on accurate financial data. Through the analysis of financial statements, organizations can evaluate important aspects such as profitability, liquidity, and overall financial stability, helping them identify strengths, address potential challenges, and allocate resources effectively. Ultimately, a sound understanding of financial statements contributes to sustainable business growth by promoting transparency, accountability, and effective financial management. For anyone interested in learning more about this topic, I have also published a paper on HSRM titled Identifying the Importance of Financial Statement in Strategic Decision Making. You may refer to it for a more detailed discussion. Thank you for watching.